Hey Credit Warriors, Credit Shifu here, and in this video we are going to be talking about how to get approved for a mortgage. Now this will be a kind of tutorial based on my own personal experience over the last few months. Just a disclaimer though, I am not a mortgage broker or realtor or anything like that, so you may want to consult with others or other resources to get a fuller picture, but I'm going to base this on my own personal experience. So let's get started. Step one would be to check your credit, all right? Before you do anything, just check your credit score. And how to do this, the Credit Karma credit score, it is not accurate, okay? Any of those, those online generic credit scores, even the FICO scores, they're still like a generic score. They're not one specifically for a mortgage. So the credit score that a mortgage uses is generally going to be lower. For example, my credit score on Credit Karma was about 775. My credit score when pulled for a mortgage was 740, okay? Big difference. So what you can do, you could either spend $60 with myfico.com and you could get your actual credit score for a mortgage, okay? There's one that's specifically for a mortgage. It's a tougher algorithm. Or you could actually just start talking to a mortgage broker and get them to pull your credit, all right? And you want to do this about 6 months out before you're actually going to seriously start applying for a mortgage and looking for houses, etc., just so that it gives you some time to get your things in order, okay? So if your credit score isn't good enough to get good interest rates, and you definitely want to be above 740 to get the best interest rates. If your credit score isn't good enough, you may want to pay down debts, you may want to, you may want to do something, you might want to go through credit repair, get certain negative items off your report, that kind of thing. So it just gives you a bit of time to prepare. I would say at least 6 months. If not a year. And then once you feel that your credit score is good enough, ideally over 740, you can proceed to the next step. So step 2 is to get pre-qualified. Now I'm going to read you out the Experian definition of pre-qualified. Pre-qualified is when you, the consumer, agree to provide your credit information to a lender in order to shop for credit offers such as a credit card or a loan. So you're going to provide your information such as your income, etc., and you're going to allow them to pull your credit to determine how much of a home you can afford and then pre-qualify you for that amount, all right? Now, a lot of people writing about this online in blogs and stuff say that it is just a soft credit pull for pre-qualified. In my experience, both the lenders that I went to get pre-qualified letters for, they both gave me a hard pull, okay? So I'm not sure why there's a discrepancy there. Maybe a mortgage broker can leave a comment telling us about that. But in both cases, they did ask for my permission to pull my credit, okay? So if there's going to be a hard credit pull done, the lender will normally always ask permission if they can pull your credit before they do that, okay? So anyway, you're going to provide these documents, and basically they're going to use all that information to work out how much of a home you can afford, and then they're going to write you a pre-qualification letter for that amount. So how do they work this out? Well, they're going to use something called your debt to income ratio, or DTI, which is a very important concept in purchasing real estate, especially when going for mortgages and loans and stuff like that. And basically, so for a qualified mortgage, okay, what's called a qualified mortgage, which I'm going to give you the CFPB definition of a qualified mortgage, okay, from the Consumer Finance Protection Bureau. They say this: a qualified mortgage is a category of loans that have certain more stable features that help make it more likely that you'll be able to afford your loan. So this is in general what you want to apply for, although there are other types of loans that people who are considered more risky can apply for. But anyway, let's kind of look at what is the standard. So for the front end debt to income ratio, basically they add together all your housing costs, which is your mortgage, principal and interest, your homeowner's insurance, your private mortgage insurance, if you have that, versus your pre-tax income. In general, they want that to be at a maximum of around 31%. But what is really important is your back-end debt-to-income ratio, which is all those home costs that we just mentioned, plus any other debts that you have to make monthly payments on versus your pre-tax income. And generally for a qualified mortgage, that can't go above 43%. 36% is the ideal. Now there may be some sorts of loans where you can go higher, but those are definitely sort of more risky things, okay? So in general, you want to look at this 43% figure, okay? I know that in the comments people are going to write, oh, you can go higher, blah, blah, blah. I know you can, but we're generally speaking, okay? So the figure is around 43%. And so let's just do a little bit of a calculation to work this out. Let's say if you had a salary of $100,000 per year, okay? We're using 100,000 because it's 100, same as a percentage. And let's say your debt to income ratio can't go above 43%. You already have $10,000 worth of debt payments per year, okay, for other things like a student loan, car loan, etc. So we are looking at back-end debt to income ratio here. So you deduct that 10,000, you'd be able to spend $33,000 per year on home expenses, mortgage, principal and interest, homeowners insurance, etc. All those, the property taxes, all rolled in. Okay, so $33,000 a year, which means that you could afford $2,750 per month on homeowners expenses. So they would write you a pre-qualifying letter basically saying that you could you can afford that much per month, or actually they'd probably give you a house, a house price, a price range to look at in the letter. Now, a pre-qualification letter is not an agreement to actually loan you any money. It just tells you in theory what you could afford, so that when you go and look for houses, people will know that you are looking within that price range and that you are a serious buyer, okay? What will really give you more weight to your application will be pre-approval, which is a later step. But now let's move on to step 3. Now, step 3 is, or can be, should we say, to start looking for a house, okay? So once you have your pre-qualification letter in hand, you can go to a real estate agent and they will view you as a serious buyer, and they will then show you houses, normally up to the amount, up to your maximum budget as stated in that pre-qualification letter, okay? Now, it doesn't have to be step 3, okay? You can actually go all the way through with pre-approval before you look for houses, and many people do that, and the advantage of that is that if you have pre-approval, you actually can compete with cash buyers, okay? Your offer is worth almost as much as a cash buyer if you're in a bidding war or something like that, okay? Because basically the lender has really, scrutinized your finances and basically given you approval that they will lend you that money, okay? It's confirmed. Pre-qualification basically just means that you can afford that much in theory, but they haven't gone through your finances with a fine tooth comb. So anyway, at this stage, you can start looking for houses, and many people do, or you can do this after you're pre-approved. You can do it either way. I started looking for houses as soon as I had my pre-qualification letter in hand. Okay, so we'll just go through it with that order, and we're now going to go to the next step. Step 4, pre-approval. So I'm going to give you Experian Credit Bureau's definition of pre-approval. Pre-approval is when a lender independently determines that you meet their requirements for credit and sends you an offer. If you're pre-approved, you can then decide whether you want to formally apply for and ultimately accept the offer of the loan or credit card from the lender or creditor. So basically, this is when they do the sort of hardcore independent verification of all your documents, okay? And this process, it's called the underwriting process. They have to send it to an underwriter who goes through it all and basically independently verifies each one. So the documents that you have to send now may include documents that you've already sent them for your pre-qualification, but there may be extra ones, okay? So it can include things like, obviously you'll need your tax returns to show how much income you make. And if you're self-employed and your business has been around for less than 5 years, they'll have to go off of 2 years of tax returns and average your income out between the two. And the income they can use for the purposes of the mortgage will be from your tax returns, okay? So let's say you earned $50,000 last year, but in the first 6 months of this year, you've already earned $40,000, meaning that you'll probably earn $80,000 this year. That does not count, okay? You cannot use income from this year. It has to be the income as stated on your most recent tax return, okay? So that can be a reason for waiting if you're gonna earn more the following year and you want to use the next year's tax return, okay? That's what I had to do. But anyway, so you're submitting tax returns, W-2s, 1099s, identification documents like passport, green card, etc., whatever you have. Then you're going to be giving them all your bank account statements for the past 3 months, okay? So that's checking, savings, brokerage, retirement, absolutely everything. And if you hold back and withhold certain account information, certain statements or whatever, and don't give it to them, well, that could be mortgage fraud, okay? If you withhold information that would influence their decision, you do have to sign a thing saying that, if you are aware that the FBI will investigate mortgage fraud, etc., it is crime. So you have to be very transparent. You have to give them everything. It is the most extreme financial audit of your personal finances that you can go through. Then other documents, well, if family members are giving you money, helping you out, they have to sign gift letters, and even their bank account statements have to be looked at to show the trail of money, like where that money came from before it came to you, okay? The mortgage underwriters, they don't want sort of random money popping up here and there where they don't know what the source of the funds is, okay? Because that could be sketchy, you know, it could be from crime or, you know, whatever. So they want to know where these funds are coming from. And basically they'll go through all of this. And then at this stage, if you've already found a house, all right, for the pre-approval, they will want to do a couple more things as well. They'll want to do an appraisal on that house. So for this house here, my appraisal cost $500. Okay, that was my cost. Could be a little bit more for some people depending on the house. But basically what they're looking at is they're appraising the value of the house, and they want to make sure that the amount that you have offered is, you know, reasonable for the house, okay? They don't want to lend you money if you've offered way more than the house is actually worth. And the next thing they're going to want is title search and insurance, okay? Now you have to get this if you're having a mortgage, okay? And what they want to do is they use a title insurance company they run a search on the title, and they want to make sure that there are no legal claims against the property, okay? So there's no tax liens, for example, like people haven't been paying their taxes, any kind of legal claim against that property, because they don't want to lend money if that property is then going to get, you know, let's say it's got $20,000 worth of tax liens against it that you're going to end up having to pay if you buy it, and then you end up getting foreclosed or whatever because of that. They don't want that. It's a liability for them. So they have to do this title search. Now for me, that cost around $4,500. It was actually quite expensive. I had to pay a deposit for it during the pre-approval process, and then the rest of it, around $4,000 or so, was rolled into the closing costs of the home. Okay, so that is quite a big thing, but you have to do that if you are getting a mortgage. So providing you have submitted everything correctly, the pre-approval process should take a minimum of 21 days. Mine took exactly 21 days, all right? But, you know, some could take longer, and especially depending on the type of loan you have. Let's say if you have an FHA loan, it takes a little bit longer. VA loan as well could take a little bit longer. But yeah, the minimum amount of time that you'd have to wait, in theory, is about 21 days. And then you can go on to the next step. Step 5, your pre-approval letter is issued. Woohoo! Congratulations, you're pre-approved. Not so fast. Well, you know, although pre-approval is a big step, okay, it means that basically, in principle, the lender has agreed to lend you the money. They may need more information from you and more steps in order to complete the rest of the process, okay? So if you haven't actually found a house yet, obviously any pre-approval will be conditional on the appraisal and the title search passing okay. And if you have found a house and you have already done your, you know, appraisal and title search, and they passed fine, they may still want more documents from you to clarify certain things about your finances, etc. In my case, they wanted loads of extra things, and each time I provided a document to answer questions about something, that would create more questions, all right? They would see something on a bank statement and be like, wait a minute, what was this payment here, you know? And then I'd have to provide another bank statement from the bank that was transferred from to you know, explain that, and then that would create even more questions because they'd then have a question about something on that statement, and it just went on for ages and ages. I think I had about 4 or 5 rounds of going through you know, documents with them, and each time I would send it to my loan officer, and then they send it to the underwriter. So the underwriter doesn't communicate with you directly, you have a loan officer, and then when she sends it to the underwriter, there's a 48-hour turnaround time. So you can imagine this can be really infuriating. If there's just one little thing that needs to be clarified, it's a 48-hour turnaround. So you have to wait 2 days. Obviously it's 2 business days. So if it happens on a Friday, you're waiting till probably Tuesday before you can get an answer on that document. And then it may even, you know, it may even create more questions, okay, and you have to provide something else. But in most cases, if you've been pre-approved, you should be able to get the final approval as long as, you know, you provide all the documents that they ask for, okay? As long as you haven't been hiding something from them or anything. If you've been totally honest, you should be able to provide everything they need to get the final approval, which is Step 6, cleared to close. Okay, so this is you get the final approval. Your closing can go ahead, and you know, a couple, 2 or 3 months of hard work are all going to pay off, and you can finally sit down with the seller of the house that you are about to buy across the table and sign all the documents. You probably won't have seen the seller yet for the past few months because normally you communicate through the real estate agent, but at the final closing, everyone will be there. So the seller will be sitting there across from you. You'll have your attorney there because you have an attorney to represent you. Probably your mortgage broker will be there. Probably your realtor will be there. You'll also have someone from the title company generally will be there as well. And you will sign so many documents that your wrist will go limp and you'll have to have some physiotherapy to get movement back in there. I certainly did. No, just kidding. But anyway, you will sign a lot of documents. You also initial a lot of documents, and then you'll get the keys and you will actually be able to move into your new house. Just make sure you set up an account with the electricity company, otherwise there will be no power for 24 hours once you move in. That's what happened to me. But anyway, this time you can relax and basically know that before too long you'll be sitting roasting marshmallows in the fire pit in front of the house that you have just bought. All right guys, that is our Credit Shifu guide of how to buy a house with a mortgage, basically all the steps you have to go through to get approved for the mortgage and eventually close on the house. I hope you liked it. If you did, please share it with your friends, etc. Please comment below with your thoughts. You can also add extra information, point out slight errors, just be nice. And if you are new, please subscribe to our channel. We offer interesting credit cards and credit in general, tips and tricks every week. We'll put some of our favorite credit cards in the description below. It is an affiliate link, so if you want to see advertiser disclosure, it's right at the bottom. And yeah, guys, we will see you next time. Thanks so much for watching. Bye-bye.